Okay, so let's get right into it. Think about India's economy as a massive ship out on the open ocean. From one side, you've got this incredible tailwind, just pushing it forward at full speed. But then, at the exact same time, a huge headwind smacks it from the other direction, threatening to bring it to a dead stop. Well, that's pretty much what's happening right now, with two completely opposite economic forces from the US hitting India at once. So, that brings us to the big question, right? What happens when this powerful push meets an equally powerful shove? Which one is going to win out? And more importantly, what does this all mean for India's economic future? That's exactly what we're going to unpack here. All right, let's start with the good news, that tailwind. This comes from the US Federal Reserve. And, according to the standard economic playbook, this should be absolutely fantastic news for India. So what even is a US Fed rate cut? Well, to put it simply, the US central bank basically makes money cheaper to borrow over there. Now, that usually weakens the US dollar, and for big global investors, that's like a giant flashing sign telling them to go find better profits somewhere else, in fast-growing places, exactly like India. And this is supposed to kick off a really positive chain reaction. It's like dominoes. First, the Fed cuts rates. Then, a flood of foreign cash comes pouring into India. All that new demand for Indian assets makes the rupee stronger, and all that new investment, it gives the whole economy a really nice boost. It's a classic win-win scenario. And look, this isn't just some abstract theory. Check out this number. When investors just thought a Fed rate cut was coming, nearly 15,000 crore rupees gushed into India, and that was in just 3 days. That shows you the kind of real-world power this tailwind has. So who gets to enjoy this economic party? Well, typically, it's the sectors that are really sensitive to interest rates. Cheaper borrowing is a huge deal for banks, real estate, and car companies. And then, as people start feeling more confident in spending, manufacturing and all those consumer goods companies get a nice lift too. But just as that party was really getting started, bam, a massive wall just goes up. Now we've got to talk about the headwind, which showed up as a very sudden and very harsh reality check. And this is it. This is the headwind. At the exact same time the Fed is sending all these positive vibes, the US government slaps a massive 50% tariff on a whole bunch of Indian goods. We're not talking about a small disagreement here. This is a direct hit on India's export engine. And the scale of this is just wow. It's staggering. We are talking about over $60 billion worth of exports. Let me put that into perspective for you. That's 2/3 of everything India sells to its biggest trading partner suddenly facing this enormous tax. The reaction was pretty much instant. You can forget all that positive investor feeling we were just talking about. Research firms like Nuvama immediately started warning that the foreign money flowing in could very, very quickly start flowing out. The entire risk calculation for investing in India had changed literally overnight. And here is the proof. Remember that 15,000 crore inflow we just saw? Well, the tariff news didn't just stop it, it threw it into reverse. A massive 42,000 crore rupees fled the country in just 1 month. So that headwind, it wasn't just slowing the ship down, it was actively pushing it backward. So this is the collision point. You got the textbook theory of what a Fed rate cut should do, crashing head-on into the brutal reality of these tariffs. Let's see what happens when these two forces actually meet. First off, let's look at the battle for the rupee. On one hand, the Fed cut is pushing for it to get stronger, but on the other, the tariffs are hurting exports and scaring investors, putting massive pressure on it to get weaker. India's currency is literally being pulled in two opposite directions at the same time. And it's the exact same story with foreign investment. The Fed cut acts like this powerful magnet, pulling money in. But these tariffs, they act like a repellent, pushing that same money away, because now there's this new India-specific risk. The headwind is directly canceling out the tailwind. And this chart, this really lays out the whole problem. That small positive bump to GDP we might have gotten from the Fed rate cut, it is completely dwarfed by the negative drag from the tariffs. Just look at the difference. Analysts estimate the tariffs could shave off almost a full percentage point from India's growth, totally wiping out any of the potential gains. Now, if we break it down by sector, the story gets even clearer. Industries that export a lot, like textiles or gems and jewelry, they are just getting hammered by the tariffs. Meanwhile, sectors that are more focused on the domestic market, like banking, they might still see a small benefit from lower rates, but the whole picture is just clouded by this bigger economic uncertainty. Okay, so this collision of forces puts India's policymakers in a ridiculously difficult position. They are caught smack in the middle, staring down a true economic dilemma. I mean, just try to put yourself in the shoes of India's central bank, the RBI. Their main job is to keep the economy growing, and that usually means you cut interest rates. But they also have to stop the rupee from completely collapsing because of the tariffs, and that might mean they have to raise rates. It's the definition of being stuck between a rock and a hard place. It's a true tightrope walk. Do they cut rates to help out all the businesses that are struggling? But if they do that, does it just make the rupee fall even faster? Their other big option is to just jump into the markets and start spending billions of their own dollars to prop up the currency. There are absolutely no easy answers here. And this is really the crucial takeaway. The short-term crisis is actually forcing a huge long-term strategic change. India is now being pushed, and pushed hard, to find new markets for its goods, to speed up its plans to diversify exports to dozens of other countries so it's not so dangerously dependent on just the US. Okay, so let's put all the pieces together and get to the final equation. What is the net effect when these two giant forces collide head-on? Well, when it comes right down to it, the traditional economic playbook just gets tossed out the window. As this analysis points out, any of the good stuff you'd expect from the Fed's actions becomes pretty much irrelevant when you're also facing trade barriers this severe. The old rules just don't apply anymore. Which leaves us with this final critical question to think about. Is this massive economic shock just a short-term crisis that India has to tough out? Or could this be the very catalyst, the long-term push that India needs to build a stronger, more diversified, and ultimately more resilient future? Well, that's the chapter that's still being written.